If you look at the equity market in technology stocks, the big players like Konuk, the biggest hedge funds in the world in technology, 75% cash. And then you see on crypto Twitter and FinTwit, people raging about the market going up. They're raging because everybody expects a leg to new lows. It's the story, and Yurian will talk about it, about are earnings going to be taken down? And I've gone back through history. I think the probability is that even if we do have a recession, for some reason, the market's not going to make a new low, because I think once you take the inflation fear off, that helps a lot, because that's the big bogeyman. And the next one is rates. And as rates start coming down, that's the other big bogeyman. And that can really give things traction. And it's a very complicated story in corporate earnings right now, because nominal versus real earnings make things really confusing. So I just have a sense that I did a Twitter poll and 25,000 people answered. And I said, how many of you think there's a new leg lower? 70%. I said, how many of you are underweight? 75%. I'm like, okay, there's no way we can go back to the lows. Well, we could go back to the lows. I find it difficult to think we could break it, even though I think the economy goes down the toilet. Look, I've got a very variant perception here. I think inflation goes negative in 18 months' time. I think the price of oil comes down to $60. I think everybody's a supply side analyst and nobody understands demand. I think the ISM, which is the driver of the business cycle, or the best kind of monthly indicator of the business cycle, I think it comes down to about 40.35. So that's a kind of negative 2% GDP print, which I think the markets will ignore for the reasons I said before, and the fact that the Eurodollar market is already pricing cuts for January. We're talking now at turning point in the cycle, right? And everybody just always looks at where we are today. Inflation's at 8.5%. How can you possibly think the Fed will cut? Well, the Fed have cut every single time in history since 1960, when the ISM has gone through 50. They've either cut or paused. They only paused once, which was 2016. Every single other time they've cut. So they talk a game, but growth leads inflation. I don't buy the structural inflation side of the story for this part of the down cycle. I can consider it for the next bull market and the next economic up cycle if we haven't built more supply in energy. And every single commodity, from wheat to copper to aluminium to everything, is down 25 to 50%. It's only oil and gas, for the reasons we know. And I think oil comes down to $60 anyway. Now, year on year, that's going to give you negative 50% oil price. So the headline CPI is almost impossible to be positive because of the year on year comps. To sum it up, bigger, faster recession. I don't think it impacts markets. I think, kind of as Kevin and Yurian think, I actually think markets are fine. I think the bond market does extremely well because it's utterly mispriced. It's the most mispriced of all the other assets versus the business cycle. So that's why I'm wearing my buy bonds, wear diamonds t-shirt. I don't disagree with Kevin that equities will do well. I'm just after capital gains. Where are bonds in a year's time? Probably at 1%, okay, in terms of yield. So capital gain is my trade. For yield, forget about it. These guys have so many pension liabilities or hurdles that, as you say, they have to do that. And we'll come into the ETH yield later because it's super interesting for these guys as well. But you're dead right. I mean, bonds really have no value, even in a pension fund, because it'll never close the funding gap, ever, at 3%. Everybody in the entire financial world is short upside calls on crypto, right? What that means is the more the price goes up, the more regulation changes, the more they have to get involved. I don't even look at the Bitcoin price anymore. It's ETH. The point being is the big pools of capital, whether it's people like Apollo or Blackstone or BlackRock or everybody, sees yield, right? They didn't own gold because it didn't have a yield. And it's difficult for them because they have the hurdle rate we talked about before for so many of their clients. But it's a bigger story than that. It's much bigger than a supply and demand story. What we're actually creating is the benchmark interest rate for Web3. So this is the big daddy of which all risk will get priced against. Everything in the world is Treasuries plus or LIBOR plus, everything. The risk-free rate is the fact that the ETH yield will be guaranteed. What won't be guaranteed is the value of ETH. So the same with the US dollar. If you buy US dollar bonds and you're a non-US investor, the bond yield will go, the currency will go up and down against you or in your favor. So this whole setup is much larger than anybody expects. If we want to see where DeFi goes, this is the big unlock. It's also the big unlock for institutions. It's the big unlock for pension funds, as long as Kevin said, regulation comes as well. This is a much larger impact than anything that's happened in this space since the launch of stable coins and the launch of Ethereum. That's how big it is to me. But it's not an overnight, you need to buy it now, it's going to go up immediately. I'm talking about structurally, as Kevin said, as regulation eases, as people understand and have clarity, this becomes a monstrous asset for this entire new financial world. Yeah. Well, I'm max long, and I have been, and it has not changed, and I just keep adding. So that's ETH, Bitcoin, a few other tokens. I've got this fund-of-fund business, so invested in that across digital asset hedge funds to capture some of the alpha of the space. Look, it's getting a little bit overbought. I think, if we're getting to trading tactics, whether we get a pullback soon or not, I think we rally into the ETH merge. I think it definitely happens. Whether it happens on the 15th, there's a story coming out that it might come out early. The 19th, it gets out of the way. As Kevin said, that removes some of the uncertainty of the space. Maybe that doesn't happen. There's still a probability that something goes wrong. Then I think it's buy the rumor, sell the fact. It's a pretty standard market operation. You buy that pullback with both hands. For what Kevin's saying, for what I'm saying about rates, for what you're saying about network growth, any big pullback you get from here, there's going to be a bunch of people saying, wait for the new lows. I just don't think you wait for new lows. You just use that opportunity. I've been saying for a long time, there needs to be a grand compromise between the regulators and the market participants. And the compromise to reach regulation is stuff like Tornado Cash. Whether you agree with it or not, it's part of that compromise. They say, we want a bit more control here. We want control over stable coins here. You can do what you want with ETH and Bitcoin over there. And some way we reach something. So this is not going to be the only sacrifice in the game. And we'll fight it and scream about it. Maybe it goes through courts and they can't think that code can be restricted in this way. But what they're trying to do is draw the lines. And we're all trying to draw the line to the other side. Somewhere we'll reach a reasonable enough compromise that, as Kevin says, allows everybody to operate. And there'll be other ones too. There'll be stuff in DeFi where they'll be saying, well, you don't know the KYC, right? They haven't done that one yet. They will do that. One of these DeFi protocols is really difficult because they're all DAOs. So they have to figure out how to do this. But somebody's going to get prosecuted there because they just want to make that statement.